Welcome back. You're watching SABC News Prime Time. Let's take a look at some of your business stories now. Credit rating agency Moody says that South Africa will avoid sliding into a recession this year, but just barely. The economy contracted by 1.3% in the second quarter of this year, and that sparked speculation about the possibility of a recession or 2 consecutive quarters of decline. Moody says that whilst recession is unlikely, it only expects the economy to grow by 1.7% this year, well below the expected global average. It says that growth of 3% is unlikely until 2017 or 2018. South Africa is struggling to grow due to global factors as well as our own electricity constraints and drought conditions. Moody says that the constraints are already reflected in government's rating with a stable outlook. The agency cut South Africa's rating to Baa2 from Baa1 last year. That's 2 notches above its speculative or so-called junk grades. Moody says that the Reserve Bank is demonstrating its determination to keep inflation in check despite the weakening rand, and government has welcomed today's statement. Well, to get us a little bit more on that story, let's join Francis now. Francis?
Thanks, Peter. So perhaps South Africa's credit rating not in danger, but growth of less than 2% predicted, hardly enough to create jobs and alleviate poverty. South Africa is caught in a storm which some are now calling an emerging markets crisis. Growth in China is slowing, of course, affecting its appetite for our metals and minerals. Despite a deal signed this week, thousands of retrenchments are still on the cards in the mining sector. Uncertainty around the timing of an interest rate hike in the US also hitting our rand. The JSE rose today, but the rand weakening once again, trading close to 14.50 to the dollar. So what's a country to do when so many economic forces that it cannot control are against it? To discuss, we're joined by the Chief Strategist at Citadel Investment, Adrian Saville. Great to have you with us, Adrian. We've been wanting to speak to you because you look at competitiveness, the level of the rand, all these things that are happening right now. But let's start with what Moody said. Do you agree we're going to avoid a recession, and is that something at least to celebrate?
It's very early into the second half of the year or into Q3. We just haven't had enough data released yet to be able to be confident that the numbers will be away from zero. But the evidence that we do have so far, I think, suggests that Q3 has been better than Q2. And given that the current quarter is an improvement, it suggests that we will avoid that curse recession, which is the statistical 2 negative quarters in a row. I think we will avoid it.
However, there's so much flux. So China is a big risk. A lot of people think that we don't really know what's going on in China. In the US, talk of an interest rate hike, but the timing's still uncertain. So could things change quickly? Are we in a very volatile situation?
We are in a volatile situation. There was some interesting commentary made earlier today on read-through into the performance of Chinese companies as a way to figure out what's really going on in the Chinese economy. There is some cynicism or skepticism about the robustness and reliability of Chinese reported economic data. I was interested in your observation about the Chinese economy sort of getting into a tough patch. 6% economic growth is a lovely tough patch to be in, but
not as good as it used to be. And
there's no 10% or 8% growth, and it's not coming back anytime soon, which means the Chinese economy heading down to its structural growth rate, which is probably closer to 5%. And that takes commodities off the boil. Also, as you point out, it's really just a question of when will the US raise, not when will they raise, and that puts perhaps some pressure on the rand. So that these turbulent times are with us. I think what this underscores, if anything though, is that the South African economy is not really its own ship, that almost all of our performance can be explained or attributed to what's going on elsewhere. And if South Africa wants to get into competitive shape, there's a lot of work that needs to be done on the structure of the economy to get us out of the pattern of being so heavily influenced or reliant on global performance.
Well, what can we do when we almost seem to be a victim of the global forces? What should we be doing right now?
Well, South Africa has some long-standing, well-established competitive strengths. And the two most obvious are agriculture and mining. And in the current environment, those would seem to be bizarre observations to make, given that we're in the grips of a drought which has got agriculture under pressure, and the mining industry where, the platinum sector is, as you also observed, on the cusp of retrenching, with the platinum price having come down from a peak of $2,500 an ounce to $1,000 an ounce. So these are two core industries which potentially they certainly have the capability to help South Africa get into the business of building industrial forestry. I think that's the point of departure.
Okay, so re-industrializing. People have been talking about South Africa even de-industrializing, losing the ability to make things, and we need to be exporting to different parts of the world. The rand is meant to be this shock absorber. So when things are bad, the rand weakens and boosts exports because they become relatively cheaper. But you've observed before that link doesn't seem to be working. Just explain what we should be thinking about the weaker rand right now.
Well, the relationship that you imagine from textbooks is that if the currency weakens, it would make whatever we are exporting priced in rands, when you convert it to another currency, is going to suddenly be that much cheaper, and lower prices should encourage others to demand the things that we are offering for sale. The reality is, when you look at the economic evidence, there's almost no relationship between the performance of the rand and the performance of the manufacturing sector. And here again, then, we have to ask, what is it that causes the manufacturing sector in South Africa to perform? No surprises, it's actually world economic growth that helps South Africa's manufacturing performance, and the rand simply doesn't matter. If it did matter, then it begs the question, why on earth didn't we take the rand to 14 to the dollar, or 20 to the dollar for that matter, a long time ago, to inject this competitiveness? The competitiveness sits elsewhere, and obvious places to look for headwinds to South Africa's performance are electricity. As things stand, we don't have the capability to provide for what is demanded. Imagine if there was a sudden surge in export demand. We simply don't have the energy capability
to even take the opportunity by the reins.
Not there.
Okay, so a lot of economists are drowning in their tears, everybody looking at the economy, but some are coming up with solutions. You've raised something in the mining sector. The tax, the so-called super tax on super profits has been looked at. You're proposing something else, taking inspiration from Chile. Tell us about that Stabilization fund.
Sure, maybe just ahead of that, making two observations about ingredients that are right in front of us, and one is on its way in terms of bolstering South Africa's capacity, and that is the repair of the physical infrastructure. The gross domestic fixed investment spend is a powerful ingredient in establishing sustained growth. And
well, very quickly, are we spending enough?
We are spending enough, but we're doing what happens with mega projects everywhere in the world. We are over budget and behind time. And this causes great frustration in commentary about the delivery of Moody, for instance, which is turned on years after the expected delivery date and well over budget. And not to be forgiving or just dismiss this as, well, that's the way things go. But I think it's just worth recognizing that we're not on our own in struggling with the delivery of mega projects. This is inherent in the nature of mega projects.
Should we avoid, I'm taking you off track, and I'm going to give you a final word on that Stabilization fund, but should we avoid nuclear then, because it's big, because there is an argument, go for the little projects?
Without question, we should avoid nuclear. If you want to spend way more than you plan to spend and get very disappointed by the delivery, nuclear is a good way to go. The other ingredient that's right on our doorstep, and this is quite literal, is the Southern African neighborhood, which ranks as the second fastest growing region in the world. Yet many South African businesses simply don't do business with the neighborhood.
Okay,
but to
so
come
it's
back
right on the
to
doorstep.
the argument of the Stabilization Fund is take the performance of Lonmin as a miner that is an important employer, notwithstanding the Marikana tragedy. Lonmin remains an important employer, and the market cap of the company has gone from 150 billion rand to 4 billion rand. That's what happens when the platinum price goes from $2,500 to $1,000. And the question is, could this have been avoided? And Chile's experience with a stabilization fund, which they put in place for the first time in the mid-1980s, was to say we are a small open economy, that's South Africa. We are geographically remote, that's South Africa. And we've got a primary export sector that is reliant on world performance. In Chile, it's copper. And the stabilization fund simply works like this. During boom times, you side pocket the surplus. You side pocket windfall. You don't give it to a super tax. Instead, you put it away for bad times. It's a rainy day fund. And when the rainy day comes, you can go to that stabilization fund and provide relief.
Okay, so you save in the good times.
Absolutely.
My final question is looking at the state of the mining sector, and very quickly, are we going to have good times, better days again?
Better days will come back. For commodity prices to lift, we have to have something like an India or a cocktail of Indonesia, Malaysia, Vietnam step in where China has stepped down. I think that external push is required. We also have to figure out ways how to turn South African mines profitable through efficiency. And that brings in the scary word called mechanization.
All right, thank you so much for your time this evening. Adrian Saville, Chief Strategist at Citadel. We take a short break and news continues.